Okay, session 40, subject financial management for 5th sem BCom students. Now, in the previous slides, we have studied about what is the meaning of capital structure and also what are the points that is considered a capital structure. As the meaning I have told you earlier also, capital structure refers to the kinds of securities and the proportionate amount that make up capitalization, preference shares and debentures. A decision about the proportion among these types of securities refers to the capital structure of an organization. Now, what are the factors that influence your capital structure? Firstly, it is financial leverage or trading on equity. Second point, growth and stability of sales. Third point, it is cost of capital. Fourth point, cash flow, ability to service debt. Fifth point, nature and size of the firm. And sixth point, it is control. Now we'll go in detail about what are the other factors also influencing our capital structure, external factors, market. Now this market plays a very vital role in the terms of sources of finance because efficient market can always provide required quantum of funds in different combinations. Next we have investors' behavior. And then what is this investors' behavior? Capital structure of the firm is purely based on behavior aspect of the investor. It is proven from many theories that the human behavior changes frequently and one will not have control of behavior of the human. This aspect is more emphasized on behavior finance. So, of course, this point also affects our capital structure. Then required rate of return. This required rate of return plays a very significant role here. As the investors well informed about the investment opportunities in the market, is the demand to return on investment increases. Therefore, this point that is required rate of return plays a significant role. Then the business risk. What is this business risk? So, the greater the firm's business risk, the lower is its debt ratio. This concept has to be considered very important because the debt ratio plays a significant role here. Then it is the risk which is measured by determining the inability of the generate profits to cover up its operating costs. This can be quantified by determining the degree of operating leverages. Next, taxation policies. Then each component of capital may demand for different kinds of return. For example, equity demands for dividend, debt demands for interest. In case of interest on debt, the corporate tax is exempted, but in case of dividend on equity, it is taxable. So this has to be recorded here. Then competition. What is this competition? So the vital capital structure is purely based on the market competition. Now, it is said that due to available opportunity for investors in the competitive market, he has a different option for this investment. Thereby, the demand for required rate of return will be highly violatable. So, this has to be considered here. Then the legal issues. What is this legal issues? Due to the changes in the legal aspects by the statutory government bodies like SEBI, Company Law Board or Companies Act and all, there will be some changes here. So this has to be incorporated immediately and maybe they have an impact on capital structure of the firm. Higher the restriction, the capital issues, higher the variability in the capital structure. Then sometimes even the next point is inflation may also have an impact on the investment pattern of individual. If an individual investor has higher borrowing capacity, he go for a risky return by borrowing the funds at the lower rate of interest. In case of interest, the borrowing funds and reinvesting in the market. This will have an impact on the capital market and this may lead to change the capital structure of the corporate firm. Then another point here is conversation or aggressiveness. Some managers are more aggressive than others. Therefore, some firms are inclined to use debt in the form of effort to boost their points. This factor does not affect the true optimum or value maximizing capital structure, but it does influence the manager determined target capital structure. The last point for this is growth opportunities. The mix of assets in place versus growth opportunities has 4 implications for capital structure. First, high assets in place make the firm have better collateral for loans. Second, bankruptcy cost and disruption caused by the financial distress are more worse for firms with high growth opportunities. Third, managers know more about their company's prospects than outsiders. Fourth, financial flexibility is more important for firms with growth opportunities. Thus, firms with many growth opportunities need more financial flexibility than assets in the place. Therefore, this are some of the factors that is affecting the capital structure of a firm.